All right, so a week ago I did this video. We talked about some very rare overbought signals. I dived into a lot more detail in the technical analysis class on our website last Friday as well as Thursday, last Thursday. Very, very rare, overbought, very parabolic move going into that options expiration. Though we did have a little decline on the last day. This week's a little different story. This week we are starting to get some signs of weakness and all across the board. So I'm going to break down where they're all at. Again, at a high level, I break it down in a lot more detail in today's technical analysis class on our website. But I'm going to kind of break down some of the signs of weakness that are developing and what we can expect to see now coming into this next week. And how this parabolic move that we had that appears to have peaked last week, what kind of consolidation can we expect to come out of it? So we're going to break down some of the big moves that are occurring in the asset classes, and for that matter, some not big moves that are occurring that you would expect that we're not getting, and what the significance of that would be, and as well as the from a sector standpoint and from all the other major markets, what are they telling us? How bullish are we based on what we're seeing in other markets and other sectors? And then finally, in other asset classes. And finally, we're going to take a look at our trade idea in a sector that's really been struggling with a stock that appears to be breaking down itself, even more so than what the broader market is. We'll talk about how to trade that. So let's go ahead and get started. Today is Friday, June the 23rd, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video that I did today at 3:30 Eastern time that I do every day. I do the Market Outlooks. Come down to the bottom, click on this heart, it takes you to this tab, hit that like button there. Same thing here, click the thumbs up icon, takes you to this tab, hit that like button. Again, that helps us get our content out to all of our followers. That's why we always ask for the likes there. Our goal is to always get above 100, so we came really close there. So let's see if we can do that again here with this video. Thank you to those who like these videos day in and day out. As always, if those who don't, you can do right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 on the market forecast indicator, like we always do here. And you can see we starting with the first day actually before expiration, and then these 4 days of this holiday shortened week. A little bit of a losing streak, 4 out of 5. The intermediate line is down, but still above 80. It is barely below market sentiment line, which is also still above 80. But both of them now slightly falling, the momentum line falling or staying in bearish territory. The near-term line also barely staying in bearish territory too, though they're off their lows that they had a couple of days ago. And you got this intermediate confirmation signal on Wednesday, which again is an oversold momentum line combined with a strong bullish posture. And then you get the near-term line also in bearish territory, but not too far, right? Not strongly into that lower reversal zone. So you had a bullish intermediate confirmation signal played out for about a day, and you're still down, but you're not down very much. This is hardly, in fact, when you look at the decline of the last 5 days, let's go rate of change, and then let's go 5 days here. So this is the decline of the past 5 days is down 1.75%. If you follow this for the past year, you notice it's not that big of a deal. It's about on par with some of these other dips that we've had. In fact, if I were to zoom out to the last 3 years, you can kind of see that, again, outside of the 2022 and early 2023, when we were in correction mode, you had much bigger declines. But you can also see over to the left in 2021 and 2020, this is about as low as it gets during these little pullbacks, especially when you have the VIX as low as it is. We'll take a look at that here in just a second. Let's look at the Dow Jones Industrial Average. You see that Its intermediate line is a little bit more bearish. You actually have pink shading, but you're still above the moving average by 0.5%, so you're not as bad. Market sentiment lines falling, did not get above 80. It's not very common for it to get above 80. NASDAQ 100, which has been a lot more bullish, has been on this bullish run now for quite a while here, going on over 3 months now, 3.5 months. The intermediate line is slightly below its market sentiment. Its market sentiment is a lot higher. NASDAQ was a lot more parabolic. And then finally, your Russell 2000, again, very similar to the Dow Jones Industrial Average. It's had a much bigger decline in the last few days. Its intermediate line, or short-term sentiment line, is more bearish too, with that near-term line dropping down. And then market sentiment line is still pretty darn low. It's barely getting out of bearish territory, as really the Russell 2000's bullishness was pretty much like all of 1 week. We had this move here, and that was about it. Coming off of this 531 low point, you had about 1, 2, 3, 4, 5 days rally. And then now, if I were to go back to the rate of change again and do a 5-day move, a 5-day rate of change. So let me bring this up over here and change it to the Russell 2000. A little bit more, 3.5% decline. That's, again, kind of on par with what we've seen earlier this year. A little bit less than what we've seen during the correction. You can see the Russell falls a lot more over the same time frame during the correction. But you can also see, too, that 5-day rally of almost 8% was tremendous. So not surprising that we're going to rotate back down into negative territory. In fact, I wouldn't be surprised if ultimately it turns into a little bit more than that, to oscillate back down from what was a strong level to begin with to the upside. Let's take a look at the market forecast on the weekly chart, since we're finishing up a week here, and you can see the short-term sentiment's bearish. You do have an intermediate confirmation signal on the weekly chart, so that sets us up for what would be a great bounce next week, because that would really solidify the breakout. So if it continues, it wouldn't be so good. And the near-term line's not in bearish territory. That would be better if it was at least below 50, if not below 40. So it's not the best intermediate confirmation signal, but it is by definition one. Oversold momentum line, just barely, but it's oversold. And the market sentiment is high, or the intermediate line there, as high as it is. So pretty decent pattern. You're close to, the intermediate line crossing below market sentiment, which is a bearish reversal. You can see it doesn't, if you get, when you get below it and stay below it. Now over here you got briefly below it, but this turned right back up with the next near-term rally, which was these bull tags here. So we're not getting a bull tag now, but you kind of get the idea that we may be headed towards one. We did get a higher close, though we did get a lower high point, so something similar to this pattern. Another similarity to this week to this particular week was we got a slightly higher close, a lower high. We also had the Hakinyashi differential crossing below its 3-week moving average, which is the purple line. And you notice that was the case again here. So we're getting another, potentially we're headed towards a transition candle next week. And transition candles aren't inherently bad. You can see that was the transition candle the week of February 13th. When you look at the regular candle for that week, that wasn't bad. So it wasn't that bad of a move. When the transition candles are bearish, if you look over here on the week of 4-4 for an example, and switch over here, the week of 4-4, that's a little bit more of a bearish pattern that we've seen. So when you're a lot more bearish and you're not so neutral, and you got more of a bearish pattern, especially closing below the low of the high week in that particular case, then that's when you kind of have to worry about an actual reversal. You didn't quite get one over here, or even over here for that matter, and it was really a 1-week decline that was all banking related at that point. So that's something to keep an eye on next week, because remember the week after is another holiday shortened week with the break on Tuesday. You got a full week next week. Let's take a look at the Dow really quick on this. Here, let's go back to the Hakinyashi. So we did have more of a bearish candle, and we did have a transition candle this week. So again, that's the concern. You don't want to have that bearish of a candle. And if you look at the Russell 2000, because remember it was down 3.5%, that was obviously a lot more bearish of a candle as well. Again, coming off of a transition candle, so a lower close with an upper and a lower shadow. That's a definition of a transition candle, is when you get a lower close and an upper and a lower shadow in the same week, when you've been trending higher, of course. So to combine that with the actual candle being bearish, again, suggests more bearishness to come. Of course, nothing's 100%, but that's the idea behind that. Let's take a look at the 3 green arrow charts. You can see we have 2 red arrows across the board. Everything's still above the moving average. Your Russell and your Dow are a little bit closer to producing that 3 red arrow signal. The S&P is kind of, the NASDAQ and the S&P are still quite a bit above theirs. So nothing too eminent there. Your S&P is below its 8-day moving average. After having kind of been pretty strongly bullish as it is, getting below that 8-day moving average is pretty significant when you have such a high. In this particular case, I wanted to show, and I showed this in my technical analysis class today, if I were to change this to 8 and 15 and 17 and the 50, so the gap here between the 17-day moving average and the 50, then you can see how close we are to getting a crossover there, and a drop below the 17 would signal the beginnings of a pullback that would really the beginnings of a convergence period, and a pullback that could really get in gear once you break that 50-day moving average. So this is it's about as high as we got on that gap back in August on a percentage basis. So a breakdown, especially if we were to break the 50, you'd be breaking below levels that we had broken above. That we don't want to break back down below, because that's fake out, right? That's when you break through an important level and you can't hold it, and you immediately break back down below that important level. That's worse than having just held it in the first place, resistance level specifically. So that's something that's kind of really important to watch over this next week here. If I were to come down and take a look at some of these other oscillators, looking at the DMI, you can see the DMI positive indicator has now dropped below the ADX. So that's the first time it's done that. This whole time we've been bullish. The positive indicator is, since over here when we went bullish, the positive indicator has been above the ADX the entire time. This is the first time it's dropped below that. And you can see when, like over here, when the negative indicator was above it during the bearish move, as soon as you crossed below it, we were done. So you wonder if we are now done with the bullish move, considering that it's back below this really, really high ADX here. Looking at some of the other oscillators like the RSI and the CCI, you can see dipping its toe below 60. So not necessarily, still tenuously in bullish territory, along with the CCI here also being barely above 0. If I were to zoom or look at the hull, you can see we are down below the hull moving average, the breakdown here. If I look up at the top, not only have we here, let me get rid of this. Not only have we changed the parabolic SARs on Tuesday, but now we have flipped the hull to red today. So you've got all 3 things here. You've got a bearish Hakinyashi candle that's not too bearish yet. It's still kind of right around the 2.5% mark, getting below that number. If you were to look, again, go out to the 3-year pattern, you can see you don't really get below that for too much when you're bullish. When you're bearish, you can get below and stay below it. But when you're not below it, you're not really getting much of a decline yet. So that kind of makes sense. We're not getting much of a decline right now, but you are below the moving average here on the hull compared to the 200-day moving average, 20-day hull. The purple line did not get very high. It got a lot higher here earlier this year. It got higher than that in November. Of course, the biggest peak was in August. That was the level that it seemed like we were the most bullish. And you can see now we've been progressively getting less and less bullish on each successive peak, even though we've been getting higher highs here. So kind of a divergence we don't necessarily want to see. Looking at the stochastics relative to its average, where the chart is performed, where the stock is relative to its 20-day range, it's below its average. The average is in the upper reversal zone. It is below the average now. Again, you can see that typically is a sign of weakness for the markets when you get that. Looking at the McClellan, looking at the breadth right now, you can see the McClellan oscillator has dropped back down, has to negative levels, which is not necessarily the best sign. It did not break below the minus 35 level yet, so we're not, it's not the end of the world. If you take a look at some of these other indicators, we'll come back to this one here in just a second when we talk about the VIX. But when we look at the new highs and the new lows, you can see it's gone negative. It's dropped down to minus 110. Of course, it needs to be updated for both the NASDAQ and the NYSE, but still easily below its moving average, and that's a sign of weakness from a breadth standpoint. Looking at some of these other oscillators, the number of stocks above their 50-day moving average has dropped back down below 300 pretty clearly now, and is actually flirting with getting below its moving average, which is not the best sign either for the market. So you can see during what little period of weakness we did have in the last few months, that's when you were below. And so we've obviously been a lot more bullish here, and every time we do drop below this average, that's when we start to fall on the S&P. If I were to zoom out so you can see the full correction here, getting below that moving average is not bullish, right? It tends to be pretty bearish across the board. So that's on that's the number of stocks above their 50-day moving average. Looking at a number of stocks above their 200-day moving average, it is still slightly above the moving average there, but it is easily below 300 again. Remember, getting above 300 was so good. To get right back down below it after not really staying above it very long, this sucks. So the breadth is already turning sour, very, very bad from that perspective. Looking at the money flow, which has been strong of late in the market to get up to a kind of this extreme level, it's looking like that this will end up, this pre-expiration peak could very well end up being an exhaustion type peak, not a gap, but considering it's such a strong range, well above the average range, and such strong volume with the money flow there, that might end up being like an exhaustion type move as we start to slowly grind down. We are below 60, though the money flow is still at least in the upper half of the chart, and when you're, as long as you're in the upper half of the chart, you're bullish. When you're not so bullish. Again, getting below 50, you can see kind of lines up with these pink periods on the markets, right? Even the brief period there, and then of course a bigger decline. If I were to zoom out, this show the full correction and the bullish market ahead of that. When you're bullish, you don't, you're not pink for very long when you don't drop below 40, for an example, or when you just barely get below 50 or 40 and stay, you just come right back up. You get below further, and you are now going to have more of a bearish decline there. So that's not surprising. During the correction, you were below 50 and below 40 for that matter, quite a bit of time. We are at least still above 50 now, so that's a positive, though you're now no longer above 60, and again coming off of a pretty strong peak, which when you get to these levels is not necessarily the best sign. So again, it's suggestive of a kind of a blow-off volume money flow move more than anything. All right, so there's that. That's leading us into expected weakness for next week as well. Oh, one more thing. Sorry, we didn't do the Ichimoku cloud. So when you are above 5 and above 80, like we did get, so we got to the mature level of the trend. As soon as you break the Tenkan line, the 9-day average here, then that's again a sign of that we're close to ending. You can see that happened over here post expiration again in August is the last time we had that. But as soon as you broke that Tenkan line, we were done, right? Just a few days later, we had hit zero on both lines. So, could we hit zero on both of these by the end of next week? Is a very real possibility. Now let's look at the Bollinger Bands and the Keltner channels. Again, we are no longer in the upper quartile of the bandwidth. We're still in the upper half, no longer in the upper quartile. We are no longer above the Keltner channels, and we're losing momentum pretty rapidly. You can see we were gaining pretty well. It was nice and steady, and then now we're going to start losing here. And depending upon, again, whether we stay in the upper half of this or get in the lower half, will be how fast this comes down. You can see it goes up, it comes down generally a little bit quicker than it goes up, especially when it grinds up like this. And then it can lead to red dots, so the bandwidth declines into the Keltner channels, and then you get the reversal, right, of the bearish move through the, you go from bullish to bearish through the red dots, and then the bands extend outside of the Keltner channels in the other directions. So that's something to keep an eye on over this next week as well, because that's, again, something I expect will be the case. All right. Let's take a look now at the intraday chart. The other thing that's kind of lining up for some weakness, some broader weaknesses, you can see the low point's already over here. It's at zero on the Arun indicator. It's going to be there for a while because the low point will ramp up to there, or will ramp up to here, or it'll ramp a little bit above zero when it goes to there, but then it will go up to hit zero again, go up to there, and then it will ramp up to here. And you can see now, as the high moves to the left on this chart, that means that the green line is moving further away from 100. Once it breaks 70, with the red line already being at zero, then we're susceptible for a reversal. So another sign of our susceptibility of a reversal here going into next week, because it's only going to take a couple more days for it to break down below 70 there. Looking at today's volume and trading range, and I talked about that over here, the volume was well above the average. We had, big time volume moves over there, but the range was at, 7 3/4 points. Today, the range very below the average. If you take a look at how the averages have been going here, 7 points way up here. And the average right now, the ATR is still sitting right at 100 or 1. So the ATR is at 1% of the actual index. That's a kind of a support level. It's a level that if we break down below, then it's a nice grind to the upside. But if it holds for support and we start to ramp back up towards 1.5, if not up to 2%, then that's the sign again of, if I were to zoom out here, of bearishness beginning. So here is where it was below 1% as we're grinding to the upside. But now, again, getting back up to 1.5 is where things start to turn south, and getting above 1.5, you're in bearish mode. You're in kind of bearish correction mode on all of these when you're, above 1.5 until it starts to fall back down again and we start to get bullish. So bullish there, and bullish here on this decline, and bullish here on this decline, and so 1.5 is great if we start getting more bigger ranges. We want to get more ranges like today for us to stay where we want to be. Volume has been gradually picking up, which is not necessarily what we want to see either. So that's something to keep an eye on as well. And then finally, the VIX is just set up for an explosive move. I mean, I mentioned in both my classes here this week, yesterday and today, I also mentioned that last week, but even worse than what we saw last week at the close is, we are clearly below 80% now. We have been for 3 days in a row. So we didn't quite get there last Friday, but this week, easily below 80%. This is extremely low VIX relative to VIX. When you look at VIX, whether it's high or low, you have to gauge it to a kind of a benchmark. In this case, the benchmark is the VIX 3M. That's, it's extremely low. When you look at it relative to itself on a average basis, so where the VIX has been average over the last 200 days. Here, let's change this to, where it's been relative to its 200-day moving average here. If I hit that, you can see it jumped up a little bit here at the close, but yesterday that was the lowest level of the past going on like 15 years, or even if you look at the last 20 years, right? This is, needless to say, it's extremely low in the 1.5 percentile of the past 20 years relative to that value of 21 over the past 200 days. So it's really deviated from that, and it doesn't deviate from that range up or down and stay there to such strong levels. And then, of course, like I said, stay there. You can see the deviations to the upside. Far less, the last time was the banking issue was the last time we got above that, and it was very brief and wasn't very big. And before that, it was coming off of that August peak, that August breakout move where the VIX spent a couple of months moving all the way up into the low 30s. So we're way more deviated now to the downside than we were then, which means we're more bullish, obviously a lot more bullish. But you combine that, of course, with the correlation, the very weak correlation of the VIX with the VVIX being below the 50% mark, has been now for quite a while. So if I were to change this to like 20 days here to get a little bit longer time frame, I mean, you're floating with being below 50%, and that's, we've been below zero, we've been below 0.5 here before multiple times, and these other instances have really led to some big moves and volatility. This one, not as big of a move. It did get up to 20 there, but now we're back below 50%, and that's an issue, especially when you combine it with how extremely low it is that I showed you before, and then you combine it with its positive correlation with the S&P 500. There we go. So you can see the briefly positive correlation that we've had with the S&P 500. I mean, all these factors are not good. Suggesting that we are in an environment where I compared it in my classes to like dry tinder. Like there's a lot of dry tinder. There's a lot of potential energy built up that just needs a spark. And who knows what that spark or catalyst is. But the environment is set up for any kind of, normally if, and you're in an environment where you get a spark or catalyst and the market just doesn't care about it, and the volatility doesn't move very much. We've seen that. You get this news and you think, why isn't the market moving on that? Because the environment's saturated. The tender is not dry. There's not very much potential energy. Not the case now. A lot of potential energy now. A lot of dry tender that's out there. That if there is a spark, volatility can increase very, very quickly. That's the environment we're in, and we're heading into an environment. We'll go through this June 4th and get through a lot of these earnings, but by going from July expiration, essentially, kind of when the earnings season is in full bore, is when the low point for volatility is seasonally. Then you go all the way to the end of October, November. So you got August, September, October are traditionally, seasonally, the three most bullish times for volatility there is, and over the course. There's some bullishness there early in the year as well, going into March expiration. But for the most part, it's the very end of July, August, September, November, or August, September, October are your most bullish times for volatility. So we're entering. It's kind of like, again, going into the summer with all this dry tender, with a really, really dry. I've seen it in Utah multiple times. All it takes is a little something, and we can get wildfires very quickly in that seasonally bullish time of year for wildfires. So we're heading into the summer, literally and seasonally for this chart. We're heading into the summer with a lot of built up potential energy for volatility to explode. Now, when I say explode, I don't mean like up to 80, but explode and get rapidly up to 20 or something. Because again, you look at the rate of change for the VIX over the last however many weeks it's been now, that it's been bearish here. So let's get to a weekly chart here. So if we go out to the last time we were bullish, the last 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 weeks that we've been on this decline for the VIX to get to this point, and it was, again, we're off the low, so it was worse. But we are near, the VIX has basically lost half its value, which is one of the lowest declines for the VIX. If I were to move this up a little bit so you can see this a little bit better, one of the worst declines of the VIX in that 14-week time frame that we've seen. going over the last however many 20 years or so. Here, let me put that line on, and you can see it as I zoom the chart over. So at 47 minus 47.315. So this is where we're at currently. You can see all these other levels where it was worse, we're coming off of much higher peaks than where we are right now. We're coming off of a peak here that wasn't very strong, and all these other levels led to big 14-week moves higher in volatility, up to 40% higher 14-week moves to the upside. And this one got up to 47% higher coming off of that low point. And you can see some of these others. This one got to 41% higher. This one got to 89% higher. This one got to 83% higher. So all of these little dips of this magnitude has led to a 14-week rally. And again, the next 14 weeks, you're looking, which is basically 3 months. You're in that seasonally bullish time of year for volatility with a lot of dry tender, and so you see that the VIX is setting up for some kind of move similar to what we've seen. I mean, it wouldn't be unprecedented. Now again, it wouldn't get up to 80. Again, last time we got up to 80, that was like a 400% move in 14 weeks. We're not going to have that kind of, even though we didn't have that big of a drop ahead of time. I mean, that was a COVID move, it was rare. 2008, very similar as well. We had a 271% rally in 14 weeks. I'm not even talking about like this kind of move, 150%. Though we could get that kind of move, but definitely in the ranges we've seen previously, kind of in this 75 to 100% rally. Is the kind of move I expect that we'll get, considering the environment we're in right now. I mean, shoot, 100% move is just up to 26, and that's just right up to this blue line. That's not even that big of a move in volatility. That's not even getting to 30 yet. Getting to 30 now would be above 100% on that. So again, that kind of sets the stage for the kind of move that we saw in early 2018, the kind of move we saw in late 2018, the kind of move that we saw kind of to get started on this correction, though that wasn't that big of a deal, and the kind of move we saw in 2015-16 when we got these corrections. 2011, kind of its own thing too with the credit crisis, about the same thing, 150%. That's the kind of move I expect that we'll see, considering these factors that are just so much potential energy built up there. Not including the fact that the S&P was so parabolic to get to this point. The S&P was. So there's a lot of technical factors in play that would suggest that last week's breakout move could very well end up being more of a fake out move by the time all is said and done. All right, now let's take a look at what's driving this price action. So let me get to the comparison chart, and take a look. You can see, of course, the Qs have been the biggest mover, bringing the S&P up with it. IWM made a late rally to catch up. It's now pulling back a lot more than the Qs are. You can still see, though, the bullishness here has not caused gold or long-term bonds to really take off yet, or the bearishness, and you can see developed markets have fallen, emerging markets have fallen. In fact, when you look at those charts here, here we go, the 12 grid for the different ETFs across the major economies are out there. Again, you're getting light pink shading. For some, you're getting dark pink shading and red line. I mean, these are kind of bearish patterns here on UK and France and Germany, Canada, and you're getting light pink shading and at least a yellow line on Japan, which would be your bull tag right there. China with a red line, Italy there too, the bull tag on Korea, and then Brazil and India are still holding up very, very well. So, you get the sense here that, looking at the S&P 500, a lot of its peers are looking a lot more worse for wear than the S&P is, and you wonder if the S&P is going to be following suit in that direction. And you take a look again at some of the Russell 2000 and how it's been performing, and commodity prices dropping hard. It's a little bit of a shock that we haven't seen TLT pick up as much this week, though it was up 1% today. Look at that. Look how converged it is. Like where the all these moving averages. In fact, in the last two sessions, you've had all the moving averages can go through the range of the last two sessions. I mean, that's how, and it was the same way the two before this one, the rolling 2-day session before this. Like, it's a very, very, and even before that, it's a very tight range. All these moving averages are just so close to each other right now. The only gap that you see is between, and even the weekly ones, is between the 50 week and the 200 week. I mean, that's, talk about, like, again, dry tinder. The TLT is set up for a bullish move. You can even see the inverse head and shoulders pattern there. It is set up for a bullish move to the upside that you already have gotten on gold. But you can see now gold, that's a pretty big breakdown below the 17-week moving average for the first time. Again, that kind of coincides with strength in the dollar. So the dollar has been bearish. The histogram, remember the histogram bottoms first, and then the histogram bottoms first, and then the actual MACD bottoms after that. It's been on a convergence mode since, as we've been kind of flirting with getting above and below the 17-week moving average. You're up today, you're up this week, but again, you can see the difference that it's had on ETF, like on the gold ETF. Like, that's a pretty bearish move. With the MACD and the stochastics, now it's almost in bearish territory itself, again on a weekly chart. Again, would suggest bullishness in the dollar, and that hasn't been the most bullish for equities. Equities have benefited from weakness in the dollar. When you look at the correlation chart here, you can see, aside from a brief positive correlation where they both went up, and it was brief here, and this is a 10-day correlation, most of the time it's negative. Let me zoom out here. Most of the time it's negative. Let's change this out to like a quarterly correlation, so a 3-month correlation here. Hit apply on that, and then let's zoom out so we can see it in a little bit more context. Again, you can see that since this correction started, it's been a pretty strong negative correlation with between the dollar and the S&P 500. It's been briefly positive. It was briefly positive last year going into that. Right after that August peak, right around that August peak where we failed, and then eventually turned negative again as the dollar took off to its peak, and the S&P declined. So you wonder, are we headed towards something like that again, to where the correlation turns negative again, but the dollar in this case is starting to ramp up to the upside, as you can see there with that chart, starting to ramp up to the upside and make its way. Here's the dollar index on a daily chart, and there's the move that we just saw there with the MACD and stochastics turning higher and getting above these moving averages here. And a pretty volatile move, pretty volatile session for the dollar today. Commodity prices, especially crude oil, has also kind of been in the news. Crude oil off of its lows of the day, thank goodness, because at the lows, that was a pretty stark 2-day decline. They are getting below all these moving averages and working lower, and you can see on a weekly chart, it's been converging between these intermediate averages and the 200-week moving average. If you take a look at the broader basket of commodities, after a great week last week, to kind of coincide with the kind of breakout move on the S&P 500, didn't follow through and get up, say, above the 30. I mean, we've seen this before. It's gotten above the 17 and failed, got above the 17 and failed, got above the 17 and failed at the 30 week every time, got up to 17 and failed. Every single time it gets above the 17, gets to the 30. This case is kind of more like this one over here, where you get above the 17 and not to the 30, and we're already failing. We're already back down below the 8, just like that. It took a couple weeks there, and it was a big, second week was a big week. 1 week there, took 2 weeks there, but again, that second week was a big week. Took 1 week there, and it's basically 1 week again. And what's the second week going to look like? And if we get some strong declines in commodities, which again, commodities are in correction mode. Corrections are when you fill in the gap between the 50 and the 200 week moving average. So, as we are filling in that gap, commodities don't correct in bull markets. And we are, you would expect if commodities start to break down to their own new lows, that would suggest a waning of risk appetite, which would also be the case in the equity markets as well. Let's take a look at the sectors and how they're performing. So let's pull up the same 12 grid for the sectors, the U.S. sectors, market cap weighted sectors, not the equal weighted. But again, you can see some light pink shading and dark pink shading. We have, in fact, staples, utilities, and energy are all dark pink shading and a red line. So they're all in bearish mode again. Remember that just briefly, they were all dark green shading and green line after having these 8 being bearish while these top 3 are bullish. Well, the top 3 is still semi-bullish, a little weakness in technology, but you're starting to, you're really reversing the bullishness that you had in all these other areas. They're really starting to come down. Like I said, 3 of them already, and real estate is that close to getting. Once that drops below 50, it will also be dark pink shading and a red line. So just like that, what was kind of a broad bullish move into this peak on the S&P 500 is now failing in its breadth, and we are getting right back down to the lack of breadth that we saw before this, that last little exhaustion type move. It's got so many makings of an exhaustion move and fake out type move there, that the expectation is that we're going to end up seeing more weakness to come in the next so many weeks. All right, for our trade idea of the day, I wanted to take a look at Wells Fargo. The banking sector has not been doing good today, and you can see here that it's got a bull tag. So it's got the 3 red arrows, intermediate lines down. It's below 80, but still in bullish territory, but it's declining. It's 0.5% below the 30-day moving average. You can see down at the bottom. Bull tags can either start bounces, as we've seen on the S&P here recently, or they can start the bearish declines. Right, every bearish decline starts with a bull tag, and so that's obviously the direction I'm leaning here as we take a look at some of these other charts. Let's take a look at this weekly chart. Unlike the S&P, it already did get a transition candle this week. This is what the regular candle looked like. Pretty bearish candle for its transition candle, and it's got the red arrow, so it's already below its 10-week moving average, and the PPO looks like it's losing its momentum, and the Heikin-Ashi differential falling below its moving average, and obviously below 0 as well. So things not looking so good from that perspective. Obviously, you do have 3 red arrows with the bull tag. You generally get 3 red arrows with that. So that's it can either be a really good bullish bounce signal, or it can be a bearish decline, the beginning of a bearish decline. If you look at where we are here, you can see the pretty significant. This is why, again, I think that we are starting a bearish decline. We are breaking below the 17 easily. We're flirting with breaking below the 50-day moving average. The MACD is clearly dropping and close to crossing 0. Stochastic is also clearly dropping. Some pretty significant momentum in both of those indicators. You can also see as well in some of these other indicators, like the DMI breaking above 25 on the negative directional index. Looking at the RSI and the CCI, they're both breaking down below 50 on the RSI, below 100, below 150 on the CCI. And then you look at the Ichimoku cloud. You were above the cloud, you are now breaking down below it. You're that close to getting a negative rate of change. What bullish trend you had has gone to 0 on both of those indicators, both of them hitting 0. So you're below the blue line now. So that's gone. And then you look at the Bollinger Bands and the Keltner channels, and you are in the lower quartile. Barely, kind of flirting a little bit above the lowest quartile, but you're in that, flirting with that lowest quartile. You've got the red dots, the bands moved inside the Keltner channels, and appears to be transitioning to some bearish momentum. So with that being said, that sets us up for a bearish trade. And so what I did, where'd it go? What I did, there it is, for this is I decided to do a long put vertical spread. So coming out here, it looks like I did it twice on accident. Coming out here and buying the 40, selling the 38. You can see what that does here. So again, it's a little bit more than, let's see, get rid of that trade there. More risk than normal, so I actually have about a little bit less than half my normal risk at $400. I'll have to close out the other half of this tomorrow. And then the gain was not $2,000, actually $1,000 of reward for $400 of risk. I really like that setup there. And you can see it's well inside of the expected range. Again, if things kind of get bad, especially with earnings coming out before expiration, one standard deviation move, I mean, it's a pretty big standard deviation as it is because of the earnings expectation. But if it were to come out of this, obviously 38 would be the easy. And again, if it bounces up pretty strongly, $400 of risk is not very much either. So low risk trade for a pretty decent reward for that risk in a relatively short amount of time, since we are only 4 weeks away to the expiration date. All right, well, that wraps us up for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody, and we'll see you all on Monday.